I'm Lisa Abramowicz. Welcome to Bloomberg Money Undercover, a show that provides valuable insights into alternative investments. We take you inside the world of private debt, equity, and real estate. Let's get straight to the burning issues in private markets. First off, disappointing debuts. From Peloton to Smile Direct, a string of lackluster IPOs shines a light on waning investor demand. Next, college cash. The grades are in. Harvard's endowment feeling the heat 3 years into an overhaul, while Brown outperforms. And Wall Street losing to private markets. We'll hear more on that and more from Tony Tutrone, Neuberger Berman's head of alternative investments. Let's get into some of these burning issues. With me is Bloomberg's Drew Singer and Sonali Basak. Let's start with you, Drew. We have seen this rough period for IPOs recently with a string of problematic deals, shall we say. What's the bigger message here?
I think the bigger message is that if you want to go public, your deal needs to make sense to public investors. So we have companies like WeWork who are trying to go public on this really broad, opaque message that one day we're going to change the way the world thinks, and we're going to just keep growing our revenue and we'll be profitable eventually. We don't know how. And those types of deals seem to be the ones that are running into the most trouble. Whereas more traditional deals, like Datadog, Ping Identity, for example, they're doing just fine.
So in other words, there's sort of some restraint on the part of investors that is leading to some sort of discipline in the market. What do you think this will do to the pipeline of IPOs? Will it shrink it?
It's a good question because there's over 400 unicorns out there, these private companies valued at over $1 billion each. And they at least the ones that are PE-backed and the ones that have employees that have a lot of equity, they've got to go public eventually, right? So you got to think these deals are going to come sooner or later. It's just a matter of when. And it seems like a very difficult time for those really big revenue stories to go right now.
Do you think that most of the deals in the pipeline are of the disciplined variety or of the maybe doesn't make sense variety?
I think time's going to tell. We need to see what some of these IPO filings actually look like and what the financials look like. But there's tons and tons of small companies in addition to these unicorns that we're talking about.
And this takes us to exactly how companies are looking to file. And Sonali, you wrote just a story about Airbnb and how they're considering going with a direct listing. Why?
That's right. Remember, Airbnb is profitable, unlike a lot of these unicorns. And remember, a lot of Silicon Valley venture capitalists don't want an IPO anymore. What they want is for companies to directly list instead to avoid that IPO pop, which a lot of people are seeing. Jay Ritter, the University of Florida, is seeing the top 3 underwriters are finding about 30% underpricing on average. So that's great for some investors that are buying in the night before the IPO, but not as good for a lot of investors who want that extra gain earlier on.
So how does the direct listing issue reflect a broader sentiment right now among Silicon Valley executives?
On one hand, you have companies that are not going public. Airbnb itself is $31 billion in its last private round. And so you have companies that are not encouraged to go public earlier on. So the hope here is that more companies won't feel like they need to pay a 7% underwriting fee and will instead be able to pay less and go public.
Thank you so much, Sonali Basak, as well as Drew Singer, for those insights. Definitely a lot at stake with the IPO market right now, given some of the turmoil, which brings me to our next guest. I am so pleased to say that we have with us the head of research for Carlyle, Jason Thomas, who joins us here to talk a little bit about how the turmoil that we've seen in the IPO market kind of may reflect private valuations. Do you think there is a broader takeaway right now?
Well, I guess my takeaway is what took so long. If we look at Carlyle Research, there's been 142 IPOs in the US this year. Only 27 have been profitable. This is the lowest share in history. On average, you have 60% of IPOs involving profitable businesses. This year, it's less than 20%. So this has been a great year to take your company public if it's unprofitable, deeply unprofitable. Finally, it seems investors have had enough, and there's been a sea change in attitudes.
So do you think that fewer companies are going to go public and they'll just stick with secondary kinds of transactions where one private equity sells to another private equity firm?
Well, if I were a public investor, what I'd be worried about is adverse selection in terms of what's been added to the public markets this year. Because what I've seen, it's businesses that actually can't get private capital. It's businesses that are either too large for a buyout, businesses that are systematically unprofitable and therefore don't meet the private equity screen, or it's businesses that are just too risky, like biotech. Biotech is about 30% of IPOs. Most of those businesses, if not all, have zero revenues. So it's very hard to have a concentrated fund position in a company like that. So that's essentially the pool of companies that have gone public. And again, I think that those are businesses generally that are not suitable for further round of private equity investment or a buyout.
So you don't think that there's sort of a wholesale statement here being made about valuations just simply being too high in private markets?
Well, no. And in fact, when we look at the performance of businesses that are profitable, and when they go public, you see 6-9 time increase in their valuation relative to their last private round. So it's been interesting in 2019, there's a lot of skepticism about private valuations, but yet those companies, when they go public, you find that the public investors are even more enthused about them.
So how do you go about finding opportunities at a very crowded period of time with a record amount of dry powder on the sidelines and private equity firms with some pretty stiff competition against one another?
Well, I think that there's concern about money chasing deals. A lot of money that's come into the asset class thinking that the investment opportunity set is static, but that's not the case. The number of public companies has actually contracted by 55% over the last 20 years. And there's actually a very significant target-rich environment involving companies that are neither sponsored nor public. And so just the data, 20,000 companies in the United States with 500 or more employees. Of those, about 3,500 are public, 7,500 backed by a financial sponsor. The rest, 9,000 to 10,000 private, but neither private, but no financial sponsor. That's quite a bit of businesses that are looking for liquidity, capital, et cetera.
So how do you source opportunities among those 10,000 businesses that don't necessarily have either a sponsorship or that aren't public?
Well, I think what's interesting is that you have the significant decline in listing propensity. So it's companies that have decided they don't want to go public, but now it's just alerting them to other opportunities to get capital to grow, to get liquidity for founders. And I think that's just marketing, it's networking, it's the spade work of private equity.
One thing that you noted in your research that I thought was really interesting was that 30 to 40% of the exit strategies included private equity firms selling to one another, so secondary deals. How concerned are you that this essentially keeps private equity firms in a sort of artificially inflated bubble that doesn't have a reality check from public markets?
Well, again, I think what's interesting about that is very often the public valuation would actually be higher. But you have a management team, the founder, the entrepreneur, that would actually like to find another sponsor to take out the existing sponsor. And that's generally how those secondary transactions occur. There's a speed, there's a price certainty. You don't have to go to a roadshow. You get all the proceeds immediately as opposed to dribbling out over an IPO. So I think that those are the reasons why there's more secondary. And again, it just comes back to if you don't want to go public, but yet your existing shareholder has to exit at some point, 3 to 5 years, that is very often the best option.
You know, when I was thinking about a theme for this week, I really thought about disappointment because we saw the debuts or the non-debuts of WeWork or Endeavor, and we saw returns that we're going to highlight later in the show when it comes to endowments coming in lower than people had expected. Do you think that investors need to reasonably reduce their expectations for what future returns are, just in a broad-based way?
I think it's going to be very difficult in the future, irrespective of asset class, to generate returns that we've seen over the last 10 to 15 years. I think it's going to be a challenge. You have valuations that are very high. You have margins, for the most part, that are very high. So most of the growth is going to come, most of the returns are going to come from growth, and most of that growth is going to have to come on the top line. And I think it's going to be very challenging to generate. So again, I think it's an issue that is across asset classes and something that investors are going to have to grapple with.
Thank you so much for being with us.
Thank you for having me.
Jason Thomas, Carlyle Group's Managing Director and Head of Global Research. Coming up, this week's power player, Tony Tutrone, who helps oversee more than $330 billion. Neuberger Berman touts why private is better than public.
You cannot make transformational changes in a public company today. There's too much short-term pressure.
I'm I'm Lisa Abramowicz. This is Bloomberg Money Undercover. Now time for Power Player, a look at some of the most notable names in private markets. The surge of cash into private markets raises many questions about valuations, but it also challenges the usefulness of public markets. Will they continue to become less relevant? I recently sat down with Tony Tutrone, head of alternative assets at Neuberger Berman, to discuss the issue.
There's no doubt in this kind of environment with high valuations, aggressive capital structures, it's going to be more difficult to get the kind of returns that private equity has gotten in the past. All that said, I still think it's going to do better than the public markets, who are also dealing with some of the same valuation issues.
How much better?
Well, I think in private equity, typically you look to do 300 basis points better than a similar index. Some are as high as 500, but I think that's still realistic going forward, even though absolute returns may come down. And then you also have to separate. There are some areas of private equity that are becoming more commoditized, but there are newer areas, more innovative areas of private equity that I think can produce even better results.
Like?
Well, look, I think one thing that's occurred in the last several years is the development of what is referred to as the GP-led secondary transactions. And one of the issues in private equity has been is even though it's long-term, the funds are finite. So GPs find themselves in a situation where sometimes they have to sell their very best companies before they're through making them better and achieving the highest returns. So what these transactions do, it gives the GP and their investors the option to roll into a new vehicle and to continue to invest in these companies and grow them so that you can achieve the kind of returns you want.
So when you talk about the returns, I want to talk about the exit strategy, because typically it's been the initial public offering.
Yeah.
You cash out. We've seen some difficulty there recently with the Peloton IPO that's been underperforming, with the WeWork IPO that was iced, with the Endeavor IPO that was iced. What message are you taking from that?
Yeah. So first I would say, Lisa, is that over the last decade or so, more than 50% of exits are sales to other companies, so selling to industries. The amount, the remaining 50 has, the share of IPOs has gone down. And look, when you look at some of these IPOs, I think the end of the day, it's about, is the story of the company, is the total addressable market there? And do the IPO investors think it's still going to grow? And I think that's really been more the problem even than the valuations, although I think there have been some unrealistic valuations that have been set in the market also.
Wait, so you're saying you don't think necessarily that these IPOs and sort of how much they've struggled indicates a broader overvaluation in private markets?
No, I think that there is, especially, I would say, on the venture capital late rounds. There's a lot of new entrants into that business that aren't typical VCs, and I think they have pushed up significantly the valuations, and I do think that's an issue. But I still think if you look at the IPOs that haven't occurred, I think it's more questions about the business model than the actual valuations. And maybe with the pricing of Peloton, for example, where it's probably pushed to the upper edge, and maybe the book wasn't as strong as the banks and the company thought it was. The transaction still got done because I think there's still strong believers in that business model.
So going forward, are you expecting the IPO sort of pipeline to diminish dramatically, given what we've seen, and just the private sales of companies just kind of take over here?
Look, I think in the short term, I think the IPO market might be a little compromised because some of these failures and some of the IPOs that haven't traded well. So I think short term, yes. And I do think that there's a very strong M&A market that you can sell into. So large companies are looking for growth. And because they're large, one of the ways they achieve growth is by buying smaller, strong companies that get them into new growth areas that can make their businesses better.
When we were talking about returns, you're focusing on private equity mostly, and I'm wondering if you also think that private debt and real estate and some of the other alternative strategies will also continue to outperform.
Look, I do. And one of my big themes is that I think the private markets will continue to disrupt the traditional markets and continue to take market share away from the public liquid markets, as well as financial institutions like banks and insurance companies. And there are really good reasons why that is occurring, right? You cannot make transformational changes in a public company today. there's too much short-term pressure, right? A lot of times when a private equity company buys a company, the earnings will actually go down in the first few quarters because they're investing in the business for the future. And by the way, there's no access for capital for small companies.
There is an argument that the public market was a way for the mom and pop investor to access American dynamism, to sort of get in on the early view of a particular growth story. How do they get in on the dynamism that is no longer going necessarily to the public markets?
The pension plans are allowed to invest in private equity, and they have professional investors and one of their biggest exposures and one of their best performing asset classes has been private equity. But in a 401k, you can't do it. In an IRA, you can't do it. And more, that's how we're expecting people to provide for their retirement. So basically, we need to bring private equity to the masses.
How much pushback do you get from investors about how much money has been flooding into some of these markets, private equity with a number of record of fundraising years? At a certain point, doesn't that concern you?
Even though there's a lot of money that's come in, the 1.1 or 1.2 trillion of dry powder is really nothing compared to the opportunity set in my mind. And again, it equals the market cap of Microsoft, one company. So we're just in the beginning innings in this market.
So where else are the power players putting their money? Well, Blackstone's chief operating officer is looking at technology that's creating change. In particular, he focused on content creation and software. Brookfield Asset Management's chief executive officer noted that there were a bunch of opportunities in India and China. And Temasek's head said that they are investing heavily in sustainable living, including water efficiency and resource efficiency. Coming up, Harvard's endowment may be the biggest in higher education, but it is still failing to keep up with its rivals. We detail its latest report card next. This is Bloomberg Money Undercover. Time now for the billionaire beat. This week, we look to the north and to Canadian billionaire Jimmy Pattison. He says businesses are stockpiling cash in preparation for a possible downturn as rising U.S.-China tensions spur global uncertainty.
We are concerned because we have we do a significant business in China, and we're very concerned about Canada's relationship with China. We do a lot of business in the United States, and we've been doing more and more business in China. What happens politically has a dramatic effect with us.
Pattison is Canada's third richest man with a fortune worth about $6.4 billion. That's according to the Bloomberg Billionaires Index. And now to college cash returns coming in now for the largest endowments, including the Ivy Leagues, and they've largely been disappointing. Bloomberg's Michael McDonald joins us from Boston with the full breakdown. Michael, I was going through the returns, and they were down noticeably from last year. On a broad-based level, what drove the underperformance?
Well, I mean, really, we need to start with the headline number, which is Harvard beat Yale. It's the football metaphor that we have to use. So Harvard came in at 6.5%, Yale came in at 5.7%. We got that on Friday night. So that's the headline that at least Harvard would like to see out there. The numbers are, we're trending lower this year. What we're seeing is these universities, their endowments, they have very significant exposure to international markets, emerging markets. Your S&P 500's up in the double digits for that fiscal year. International markets are, they're mostly flat. So with that bias in place, we're seeing, a drift downwards, an underperformance against what you would see these domestic equity benchmarks. But I think, the greater scheme of things, what they look at is each other, and at least Harvard's celebrating right now.
They might be celebrating, although they've had a pretty rough run of it. And I'm wondering if you dig into their returns, the 6% returns compared to more than 10%, I believe, last year. And I'm wondering whether the decline was largely due, again, to that South American agricultural real estate that we were talking about last show.
Yes. So the sense that I have is that we're going to see natural resources again weighing on their portfolio, and that's been an ongoing issue for them. That's part of this revamp of the portfolio, some risks that were taken that they want to get out of that portfolio. I think the general drift lower, again, it's like international markets. We do know that Harvard significantly increased their exposure to hedge funds over the last couple of years, doubling it to something in the order of $13 billion. There's a mix. There's some good performers in there that I know about, and there are some that haven't done so well. When you got a $40 billion portfolio, it's hard, when you've got one really good performer to really move the needle for you. So, they're trying to turn things around. Their performance is lower than last year, but again, I think they're pretty happy with where they are relative to some of their peers.
What about Brown? Brown came in as the leader, Brown trouncing them all, so perhaps that will be the headline over in Providence, Rhode Island. I'm just wondering what led that outperformance relative.
Yeah, sure. So, and I will point out, we got to go back to the football metaphor. Brown lost to Harvard 42-7 on Friday night, so that is sweet revenge on the part of Harvard that they were able to beat up on Brown at Harvard Stadium. The portfolio at Brown, you've got a former hedge fund manager, Joe Dowling, who's running the portfolio. It's relatively small. He's a former Tudor guy. He's outside of the box in terms of the kinds of CIOs that we usually see. He's got a very large hedge fund position relative to his peers. So clearly he's made some good bets, and it can, when you've got a small portfolio around $4 billion, that's big for you and me, but for an endowment, that you can really move the needle if you've got some really significant outperformance among some of your bets.
Just real quick here, the trend across the board, are they increasing or decreasing their allocations to private debt, private equity, and hedge fund strategies?
We're seeing a mix of things so far. One thing we are seeing is you are seeing more cash. You are seeing the hedge funds are pretty, the allocation is quite large, which does suggest that maybe they are thinking about the end of this cycle.
Michael McDonald of Bloomberg News, thank you so much. And that brings us to this week's big number, which is, drum roll please, $103.3 billion. That is the total tally of loans of concern as rated by Fitch Ratings. Over the past year, that's up by almost 40%, and that's retail companies and energy companies accounting for the majority of the most severely stressed debt. Also pharmaceutical companies, particularly facing some opioid litigation, also falling into the ranks of concern. That does it for us. Reminder that you can watch us each Tuesday at 1 p.m. New York time, 6 p.m. in London, 1 a.m. Hong Kong. This is Bloomberg.